Planning ahead for long-term care costs almost always beats scrambling for it later. Wait until a health crisis hits and you end up with fewer options, higher costs, and decisions made under pressure, not clarity. Here's the number that should get your attention. Nearly 7 out of 10 Americans aged 65 and older will need some form of long-term care in their lifetime. The average length of that care is 3 years. Women typically need it longer than men, and 1 in 5 of us will need care for more than 5 years. So the real question isn't if you'll need a plan, it's how you're going to pay for it. Most people assume or just hope Medicare will cover it. Medicare does not pay for custodial long-term care. Bathing, dressing, eating, using the bathroom, getting in and out of bed, walking, medication, reminders, supervision for dementia, doesn't matter if that care happens at home, in assisted living, or in a nursing home. Medicare generally does not cover it. What Medicare does pay for is medical care, short-term skilled nursing, after a qualifying hospital stay, physical occupation and speech therapy, medically necessary home health visits, and certain hospice services. Say someone breaks a hip. Medicare may cover a stay in the skilled nursing facility for rehab, but the moment they no longer need skilled medical care, they just need help getting dressed. Medicare coverage generally ends. That's the gap. So how do people plan to fill in that gap? A lot of them buy long-term care insurance and assume it'll be there the moment they need it. But the fine print matters more than most people realize. Most policies don't pay out until you're certified as needing help with at least 2 of 6 activities for daily living, like bathing, dressing, for at least 90 days, or you're diagnosed with a qualifying cognitive impairment like Alzheimer's. On top of that, there's an elimination period. Think of it like a deductible, but measured in time instead of dollars. Most policies let you choose 30, 60, or 90 days. During that window, you're covering the cost yourself. Once benefits kick in, most policies pay up to a daily limit until you hit a lifetime max. There's the part people don't expect. Search online and you'll find plenty of stories of people who met the trigger requirements and still had to fight. Sometimes with attorneys, to get their policy to pay. That's not what you want during a health crisis. So what's an option that doesn't come with triggers? Waiting or claims disputes? If you own a home with significant equity, a home equity conversion mortgage or a HECM is worth a serious look. Here's the core difference. Long-term care insurance is a bet you place years in advance. You pay premiums now, hoping the policy pays out later. A HECM isn't a bet on anything. It converts equity you've already built into a growing line of credit you can access. It doesn't require monthly mortgage payments. If you had one, it gets paid off with remaining equity, funding your credit line. After the first year, there are no triggers to meet, and the costs are built into the loan, paid when the home is eventually sold. Not out of pocket. The only upfront costs are the third-party fees. A counseling call around $150, and appraisal typically $800 to $2,500. Let's put real numbers next to this. In 2026, a 55-year-old man might pay around $950 a year for a basic long-term care policy, closer to $2,200 with inflation protection. A 55-year-old woman pays about $1,500 a year. Premiums jump sharply, and those premiums aren't guaranteed. Insurers have issued rate hikes of 50 to 200% on existing policies. Meanwhile, care isn't getting cheaper. 2026 data puts the national median at over $80,000 a year for full-time in-home care. A HECM has real costs too. Origination fees, mortgage insurance, closing costs, but they come out of your loan balance, not your bank account. And the money isn't restricted to care that meets a claims adjuster's definition. It can pay a caregiver, cover medical bills, modify your home, or keep a handyman or housekeeper on call so you can stay independent longer. So which is right for you? Long-term care insurance tends to make sense if you're young, healthy, and comfortable absorbing years of premiums. A HECM tends to make sense if most of your net worth is tied up in your home. You want flexibility instead of claims? and you'd rather not gamble on premiums staying affordable for the next 20 years. They're not really competing for the same job. One is a hedge you buy before you need it. The other puts an asset you already own to work on your terms when you need it. Take Alan and Lucy, for example. They're in their mid-60s, relatively healthy, both non-smokers, and they do love getting takeout, indulging in sweets, and they both will tell you they could stand to lose a few pounds. Well, in 2024, Lucy had a stroke that caused her entire right side to be paralyzed. She needed all kinds of care after that, and all the duties she used to do and be able to do around the house became very clear when they stopped being done. Alan was overwhelmed with the day-to-day managing the house on top of all of Lucy's doctor's appointments and therapies. He needed to hire a housekeeper to come twice a week, a landscaper to keep the yard up since he was gone so much or had to stay with Lucy inside, and a part-time caregiver that came 3 times a week to help Lucy with hygiene and give Alan a break so he could go to the store, run errands, and catch up with friends without leaving Lucy unattended for too long. All of this help was expensive, and even if they had long-term care insurance, which they could never afford, it wouldn't pay for all of these people. Getting a home equity conversion mortgage was a no-brainer for them. It gave them liquidity to be able to afford whatever they needed without worry. If most of your wealth is sitting in your home equity, it's worth finding out what your options actually look like. Reach out and let's walk through your numbers together and build a plan that keeps you in control before a health need forces the decision for you.